Welcome back to the Deep Dive. Today we're opening up the playbook for 2026. We're talking about how commercial real estate investors are actually closing deals.
Right, even when high interest rates and really tight banks are trying to shut the whole market down.
Exactly. This isn't just a list of ideas, this is a tactical guide. We're calling it Creative CRE Financing Strategies, and it's built for a world where, frankly, traditional debt is just expensive and hard to get.
And before we jump into the 11 strategies, we really have to get a handle on the sheer gravity of the situation. It explains why this kind of creativity is suddenly dominating the market.
Okay.
When you go to a conventional lender today, you're facing what we've been calling the triple threat of debt restriction.
The triple threat. So tell us about these restrictions. What are banks demanding that's making high leverage deals, basically impossible?
Well, first, it's the loan-to-value, the LTV. They're maxing out around 55, maybe 65%.
That's already a huge chunk of cash you have to bring.
A huge chunk. Second, the pricing is punitive. We're seeing 150 to 200 basis points over SOFR, which is significant. But maybe the most restrictive part is the high debt service coverage ratio, the DSCR. Banks are demanding 1.35x, sometimes all the way up to 1.5x.
Okay, let's pause right there. A DSCR of 1.50x. For our listener who might not live and breathe this stuff, what does that mean in plain English?
It's actually pretty simple. It means that for every single dollar of debt payment you owe for the year, the property has to be generating $1.50 in net operating income.
So a massive cushion.
A massive cash flow cushion, exactly. Yeah. If your property just barely covers the loan, say at 1.1x, the bank wouldn't even look at it. And on top of all that, these loans often still demand full recourse.
Meaning they come after your personal assets if the deal goes sideways.
They come after everything, not just the property.
And this all leads us to this ticking time bomb that really makes this whole deep dive essential. We're looking at something like $1.9 trillion in CRE debt maturing by 2029.
And the crucial part is that most of that debt was written when rates were, happily fixed at 3 or 4%. And leverage was easy to get at 75, 80%.
It's a completely different world.
A completely different world. Those properties, especially like older office buildings or some retail, they simply cannot cash flow at today's rates with that 1.5x DSCR standard. They're underwater before they even sign the papers.
So that massive debt wall is what's forcing this creativity.
It is. And that's our mission today, to unpack the 11 mechanisms that investors are stacking to get to 90 or even 100% financing and completely sidestep the banks.
All right, let's jump right in. The first pillar of the playbook, it focuses on using the seller and existing debt. These are the low cash plays. And we'll start with what you're calling seller financing 3.0.
Yeah, and this is so far beyond just, the seller carrying a simple note. This has become institutionalized.
How so? What does the structure look like?
The structure looks a lot like a private equity investment. The buyer puts down, say, 20 to 30% cash.
Yeah.
The seller carries the rest at a pretty competitive interest rate, maybe 5.75 to 7.25%.
And what about the term?
The term is long, 7 to 15 years, and it's often interest only for the first few years, which really helps the buyer's cash flow.
Okay, but why would a seller agree to that? To get payments stretched over a decade instead of one big check at closing?
The motivation is almost always taxes. By structuring it as an installment sale, they can defer a huge capital gains tax hit. Instead of paying a massive tax bill in year one, they spread that liability out over 10 or 15 years. For a high net worth seller, minimizing taxes can be way more important than getting all the cash up front. It's a true win-win.
That makes a ton of sense. All right, next up is a strategy that I have to say sounds risky, but has a huge reward. Subject to plus a wrap mortgage.
It is definitely aggressive. The idea is you acquire the property subject to the existing low-rate mortgage that's already on it.
So you're just taking over the payments.
You're taking over the payments without officially assuming the loan. Then the seller issues a second mortgage, a wrap mortgage, for the difference in price.
Wait, hold on. This immediately brings up the dreaded due on sale clause. Doesn't that let the original lender call the entire loan due the second the property changes hands?
It absolutely does, and you've hit on the critical risk.
Yeah.
You cannot ignore it.
So how do you get around it?
Well, sophisticated investors use two main mitigations. First, they use special legal vehicles like a land trust to hold the title. This lets them transfer the control, the beneficial interest, without technically changing the recorded deed.
Okay, that's clever. And the second way?
The second way is much harder, but it's seeking servicer pre-approval, or, just working with lenders in certain CMBS pools who have a history of not really enforcing the clause. It is high risk, but the prize is inheriting like a 3.5% interest rate.
A huge prize, for sure. Now, for a strategy that gets you control with basically no upfront debt, the master lease option. You called this one the zero down king.
Because it really can be zero down, or very close to it. The investor gets into a long-term lease, maybe 7 to 10 years, which gives them immediate operational control. And crucially, they get an option to buy the property at the end.
And during that lease period, they keep all the upside.
100% of the upside.
And when you say upside, what are we talking about specifically?
Cash flow improvements.
Yeah.
If you, the investor, go in and you raise the rents or you slash operating expenses or fill up a vacant building, all that new net operating income, that NOI, it flows directly to you, not the owner.
So you're building value and equity before you even own it.
Exactly. You're proving out the asset while locking in a purchase price to the option strike price, which usually just has a small, 3 to 5% annual escalator. It's an amazing way to stabilize a property before you have to go get expensive bank financing.
A phenomenal transition strategy. Okay, let's shift to our second focus. Actively hunting for low-rate loans and then layering debt to get maximum leverage. We should jump to assumable debt hunting.
Yes, this is the cornerstone. It's exactly what it sounds like. You are scanning the market for existing loans that let a new buyer just step into the seller's shoes and take over their debt.
And there's still a lot of this debt out there.
Billions of dollars, often from Fannie Mae or Freddie Mac, especially in multifamily or in some CMBS pools.
And the rates we're talking about are basically historic lows.
Oh, absolutely. We're talking about rates stuck between, say, 2.65 and 4.1%.
Wow.
And the huge advantage is the only cash you really need at closing is the equity boot, the difference between the sale price and the loan balance. You get to completely bypass today's high-rate, high DSCR banks for the biggest part of your capital stack.
That dramatically lowers the cash needed. But what if that assumable loan only covers, say, 60% of the deal? How do you fill that other 30% gap without a recourse bank loan?
And that takes us directly to strategy 5, mezzanine debt and preferred equity.
The vertical leverage stack.
This is how sophisticated syndicators build it. You start with your senior debt, 60-65%. Then for the next chunk, you bring in mezzanine debt for another 15 to 20%.
And that's secured by the equity in the company, not the property itself.
Correct. It sits behind the senior loan. And then for the final piece, you might top it off with preferred equity or pref equity for that last 10 to 15%.
So you're stacking these up to 90-95% leverage. How does this protect the investor from that recourse risk we talked about?
Because mezz and pref equity providers are taking on way more risk, they charge higher rates. But in exchange, they're often willing to give you non-recourse terms.
What if the project fails?
They can only go after the asset itself or the equity in the LLC. It protects the general partner's personal balance sheet. That's what makes high leverage palatable for the big players.
Protecting the balance sheet is everything. Okay, let's talk about a scenario where speed and getting 100% financing are the only things that matter. That's strategy 4, 100% financing funds.
This is a pure bridge strategy, a timing tool. These funds, they're often like institutional hard money. They will cover everything. Purchase, CapEx, closing costs. The catch, as you can imagine, is the price. We're talking 11 to 14% interest.
Whoa, 14% sounds like loan shark territory. How could you possibly justify that rate, even as a bridge?
You justify it when the alternative is losing the deal entirely, or when getting to market fast is the only thing that matters.
Okay.
You use these for a very short window, 12 to 24 months. You buy a distressed property, do a rapid renovation, stabilize the income, and then you immediately refi out into a permanent, much cheaper loan.
Oh, so the high rate is just an expense to capture a much bigger prize.
Exactly. You capture the arbitrage on the stabilized asset's new valuation, which far outweighs the 14% you paid for 18 months.
That completely reframes it. Okay. Focus 3, specialized capital and tax efficiency. Let's start with strategy 9. Reg D 506C syndication.
Right. Syndication is simply the process of replacing restrictive bank debt with private equity from accredited investors. You pool capital, anywhere from $5 to $50 million, And the lead sponsor can get to 90% plus leverage because the investors are taking the risk a bank won't.
And this lets deals close super quickly, right? Which is a huge advantage.
Very fast. We've seen sources say big raises can happen in 30 to 60 days. The key is having clean documents and strict SEC compliance. And maybe the most critical element is the waterfall.
Let's quickly define that jargon. What exactly is a waterfall in this context?
The waterfall just defines the exact order and the rules for how cash flow and profits cascade down to all the different investors.
Who gets paid first?
Who gets paid first, at what return hurdle, and how the rest of the profits get split. A clean, transparent waterfall is absolutely essential to attract serious investors under these 506(c) rules.
Got it. Next up, a classic for unlocking equity. Strategy 8, the sale-leaseback.
Yeah, this is for owners who need to get 95 to 100% of their property's equity out, but without moving their business.
So they sell the building.
They sell the asset to an investor, usually an institution, but at the exact same time, they sign a new, long-term, 15 to 20-year absolute triple net lease, an NNN lease.
So the seller gets a ton of cash instantly, and they keep operational control.
They keep control. They're a tenant, but under that NNN lease, they're still paying for all the operating expenses, the taxes, the maintenance. It's hugely popular for operators who are experts in their business like doctors or manufacturers, but don't want to be real estate speculators.
They monetize the real estate to grow their core business.
Precisely.
Okay, for investors who are looking for passive income and have tax needs, we have strategy 7, the 1031 exchange into a Delaware statutory trust, a DST, or an UPREIT.
This is the passive play. If you're selling a property and you're in a 1031 tax-deferred exchange with that tight timeline, DSTs and UPREITs are basically prepackaged institutional-grade replacement properties you can buy into.
And the main benefit here for the investor?
Zero management.
Yeah.
You get steady cash-on-cash returns, often in the 6.5% to 8% range, and you get the full tax deferral. It's a way to get out of active management while still following the 1031 rules.
Makes sense. And we have to briefly touch on the hybrid plays. We've got strategy 6, the EB5 3.0, plus an opportunity zone hybrid. How does this lead to what you called nearly free equity?
So EB5 capital is foreign investment meant to create U.S. jobs. It's really attractive because the interest rate is incredibly low, like 1% to 3%, with a very long repayment schedule.
So it's very cheap money.
It's almost free money. And when you combine that near-zero cost capital with the tax breaks from an opportunity zone, you are getting capital that feels like equity but costs almost nothing to service during that critical development phase.
Truly specialized capital. And finally, strategy 11, the joint venture, or JV, and profit-sharing waterfalls. This is what powers new development deals.
Absolutely. A JV is all about aligning skills and capital. Most commonly, you'll see a landowner contribute the land, the GERT, for a new industrial park, for instance. And then the sponsor brings the cash, the expertise, and the construction financing.
And the profit-sharing waterfall, that's just how they agree to split the profits.
Precisely. It's not a simple debt structure. The profits are split based on pre-agreed tiers that reward risk and contribution. It's a custom-engineered financial partnership, really.
Okay, we've covered 11 distinct strategies, but you said the real genius is in the stacking. So let's walk through a specific example, the industrial stack you mentioned.
This is the recipe right now. So imagine you're buying a stabilized industrial building. The stack starts with 62% assumable Freddie Mac debt at a beautiful 3.55% rate.
That's your low-cost foundation.
Right. Then you layer on 18% in a seller's second mortgage. The seller provides that, gets their tax deferral. Then you top it with 15% mezzanine debt, which gets you the high leverage, but is non-recourse.
Okay, so that brings us to 95% financed, and we haven't even talked to a traditional bank.
Correct. The final 5% is the actual cash the investor brings to the table. 100% financed. You've completely bypassed the commercial banks and locked in a sub-4% rate on 2/3 of the deal.
That's incredible. And what about a tax-efficient exit stack?
Right. So think about a doctor selling her medical billing. She does a sale-leaseback to get maximum cash. The buyer is someone doing a 1031 exchange, which creates instant demand. The property is sold with a brand new 15-year NNN lease, which makes the cash flow super predictable.
And that predictability helps the buyer's financing.
Exactly. That predictable cash flow can then support a preferred equity layer on the buyer's side, which boosts their leverage, all while they're getting a high-quality tenant. The strategies just feed each other.
But with all this creativity, you have to talk about risk. Let's drill into the key risks. First, recourse creep.
Recourse creep is the danger. that as you add all these layers, seller paper, mezz lender, you slowly lose the non-recourse protections you had on the senior loan. Suddenly, the mezz lender and the seller both want personal guarantees.
And you're right back to full recourse. So what's the mitigation?
It is purely about negotiation. You have to fight for strict non-recourse language on those mezz and pref equity layers. You limit the recourse to only bad boy carve-outs, things like fraud, not just performance failure.
And what about managing the risk of a rate spike when you're using short-term or floating debt?
You fix what you can and you insure what you can't. You get a fixed rate on the seller financing. For any variable debt, like a bridge loan tied to SOFR, you must buy an interest rate cap. It's an insurance policy that puts a ceiling on how high your rate can go.
It protects your cash flow projections. And finally, the most critical risk of all, NOI shortfall. Your projected income just doesn't show up.
The mitigation here is just rigorous, almost paranoid financial modeling. The sources all say you have to stress test your numbers by assuming your costs are going to be 150 to 200 basis points higher than you think.
Why that specific margin, 150 to 200 basis points?
Because that buffer accounts for unexpected vacancies, rising operating costs, or a rate bump when you go to refinance. If the deal still works with that cushion built in, it's a robust deal. And this leads to a fundamental truth. Higher proven NOI means lower risk.
Which means better financing terms.
It means better terms and more interest from all these sophisticated capital sources.
That is the actionable shortcut. Now, for the listener, let's just consolidate this into a quick decision matrix based on your primary goal.
Okay, if your main goal is minimizing the cash needed, so you're targeting 0 to 10% down, your stack is a master lease with a joint venture, or you use one of those short-term 100% funds.
And if your priority is just getting the absolute lowest rate possible,
Then you should be spending your time hunting for that assumable debt and pairing it with a seller's second mortgage. You'll need a bit more equity, but your rate will be far below market. And finally, if your main driver is tax deferral, your stack is a 1031 exchange into a DST or an UPREIT, maybe with an opportunity zone layer on top.
so when we zoom out, what does all this mean for commercial real estate in 2026?
It means the era of easy, cheap bank financing is over, at least for now. Success relies entirely on combining these non-traditional strategies. It's the only way to get high leverage, keep your cash requirements low, and get specific tax benefits. You're effectively sidestepping the entire traditional banking system.
Investors aren't waiting for the Fed anymore. They're engineering their own deals.
Exactly. They're engineering their own deals.
Which brings us to a final provocative thought. We know that $1.9 trillion in low-rate CRE debt has to mature by 2029, and we know conventional financing is impossible for many of those properties.
Okay.
So how dramatically will the market shift when the big institutional lenders holding all that debt are forced to start offering debt assumption or their own seller financing programs just to avoid a wave of massive defaults? This creative playbook might not be the secret weapon of the few for much longer. It might become the mandatory standard just to keep the market stable.